first, your view right now on this market is what?
I think that markets are showing some relief that CPI was dovish, and actually I think some of the inflation prints the last 2 days have been dovish, including PPI. So it's setting the stage for yields which kind of were close to touching 5% to kind of cool. And at a time when sentiment's been negative, I think we should be rallying.
Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks were mixed on Thursday, with the major indices struggling to build on the previous day's surge amid another round of big bank earnings, and investors also watched the Capitol Hill confirmation hearing of President-elect Donald Trump's pick for Treasury Secretary Scott Bessent. Now, markets are coming off a major one-day rally on the heels of a surprise easing in consumer inflation that prompted questions about whether the pricing out interest rate cuts this year had gone too far. Stocks ripped higher on Wednesday. Yesterday, this was also further exacerbated by some of the bank earnings we got yesterday. However, that same momentum didn't follow through in the megacap names, but it did in the broader markets. Look at Apple, Nvidia, Google, Meta, Amazon, Tesla. These bigger names didn't quite continue the momentum they saw yesterday, but the broader market did. Everything in finance was still broadly positive. Utilities, manufacturing, healthcare, technology, industrials, everything was actually largely positive if you dive a bit deeper under the hood. And if we just look at technology services, this is the quintessential sign of the market. You have these big names down in a big way. Microsoft kind of flat, slightly up. The rest of technology services, very, very green. And that's really what we saw today. In fact, more sectors gained than lost, with utilities up 2.15%, real estate up 1.7%, the XLI industrials up 1%, and again, building on the gains from yesterday. But we also saw energy, staples, materials, financials, healthcare, all in the fold at the top of the mix. And it was some defensive sectors at the top, rate sensitive sectors, cyclical sectors too. There was no real rhyme or reason as to what rallied. What the market just didn't want any a part of was like richly valued tech stocks. And that's why large caps took it on the chin today. Large value, core, and growth were all down. Except large value, which was only flat today. It's still red. They should really make this box gray. But we saw mid caps outperformed. Mid caps were the standout, especially mid cap growth up 0.7% year for the day. And small cap value was down 0.2%, but a ton of small cap value is mostly just like regional banks. I think they're just having a little bit of consolidation, profit taking on the back of yesterday's move in financials. But small cap core, small cap growth, very solid. Definitely both these sectors outperforming large caps, and that's kind of what we saw in the market year today. I mean, the global economy, look at Europe, right? Look at Asia, look at Australia, very, very green. The US was kind of green. And then when you look at America, it says green, but America was kind of flat here today. It should actually be like gray. I don't know why they make flattish green. And then we saw South America, a little bit of a dumpster fire. Nonetheless, the same price action we saw in the S&P 500, we saw in the global economy. There was a lot to like today. One of the biggest news stories that came out was Taiwan Semiconductor's Q4 earnings, and it was stellar, guys. Taiwan Semiconductor reported a 57% increase in profits. Their 3nm and 5nm nodes led the top line growth. They expanded their margins, issued strong Q1 guidance, and still said that the outlook remains strong, particularly for AI. The market rallied on this. Taiwan Semi was up 4% on the back of this news. Nvidia, ASML, and semiconductors were actually very upbeat into the market open, but cooled off as the day went on. Something that was very surprising was luxury stocks, particularly European luxury stocks. They jumped after Richemont smashed expectations. They beat third quarter, they beat on the top line and the bottom line. They also saw margins expanded, and then the rest of the luxury market rallied. LVMH, Hermes, Burberry, Kering, they were all up anywhere from 4 to 9%. Very solid day in luxury. And hopefully this does continue. And hopefully the earnings that are now baked into these names can live up to expectations. But a lot of these names have been battered. Like LVMH was making 52-week lows just a couple of weeks ago, but there seems to be somewhat of a revival. But it's really going to depend a lot on China, particularly for LVMH, Hermes, Burberry. These are all heavily China-situated names, whereas Richemont has more like US exposure. Nonetheless, luxury is back in favor. That's really good for European stocks. We also got some bank earnings today. Bank of America released their fourth quarter results. They more than doubled their quarterly profit as the bank benefited from a Wall Street deal-making revival that also boosted earnings. At its rivals, its shares was up slightly in early trading. However, they were down on the day 1.87%. So why were they down on great earnings? That's because Bank of America was up 7% yesterday. So a lot of today's gains were actually pulled forward after some of the bank earnings we got yesterday. And then we also saw United Health. They were down 5.23% because fourth quarter revenue fell short of estimates, dented by weakness in its health insurance unit. And the stock just kept making lower lows throughout the day. And again, I believe this is a 52-week low for United Healthcare. Very brutal action in the healthcare space. This company has had trouble after trouble, and earnings couldn't help it out today. Now, looking at the economic calendar, guys, very, very interesting. Now, retail sales came out and it was a little bit weaker than expected. Retail sales was up 0.4%. The consensus was 4.6%. However, ex-autos came in line at 0.4% when you look at the actual versus consensus. And also, when I dove into the retail sales report a little bit deeper, and if you actually look at the control group, retail sales control on Thursday, which includes several volatile categories and factors in gross domestic product for the quarter, that number actually came in at 0.7. That was the actual number versus the consensus estimate of 0.4, and that was retail sales control. So the retail sales, yes, the headline figures look a little bit weaker than expected, but if you dive into the weeds like retail control, which actually matters and adjusts for GDP, the consumer is still looking very, very strong. And then we actually had initial jobless claims 217 versus 210, beat expectations ever so slightly, but that you don't want that. You don't want a stronger initial jobless claims. Nonetheless, we had previous revisions that were positive, and so essentially initial jobless claims came in at expectations. And we'll talk about what yield did today on the back of this economic data, because even though it looks bad on the headline, we'll see what yields did, which really tells us how the market viewed the economic data that was released today. We also did get better than expected export prices and inline import prices. Very solid economic data, if you ask me today. Just the headline figures looking a bit weary. But then looking at market breadth, we actually did see more stocks gain than lose again. We tend to see that broad market trade, or what I call the value trade, that value rotation is back in favor. And we had 3,300 advances, 2,800 decliners, but the market was flat because a lot of the Magnificent Seven names were in this section right here in the decliners. And then market momentum, guys, we continue to build on what we had yesterday, both in the shorter term moving averages and the longer term moving averages. All we need to do now is take some of these medium term moving averages, and then the market can continue the momentum onward and upward from here. But what we really saw today was simply just a consolidation of yesterday's gains. The S&P 500 flat, the Nasdaq 100 slightly down 0.38%, but they were the outperformers yesterday. And then the IWM and the RSP actually gaining. The mid caps gained as well, 0.85%. A great build on yesterday, and profitable small caps were up 0.4% respectively. And you could see, yes, we did see a little bit of selling in the Nasdaq. Overall, we're just sort of consolidating the gains that we made here yesterday. Now, guys, on the back of the retail sales data, if you look at yields today actually continued their fall from yesterday. The 2-year, 10-year, and 30-year yield was down. The dollar fell 0.11% as well. But if you actually look at when the data was released, we did actually see a pop in yields, right? So that's telling us that the market looked favorably on the economic data we got today. So that actually builds on a stronger economy. Just on the back of yesterday's CPI, we then saw yields actually continue their move lower. And this actually supported the price action we saw in stuff like the IWM, mid caps and small caps. And the weaker dollar did support some of these larger cap names in stuff like the RSP and the S&P 500. Metals were fairly positive today. Gold was up, so too was silver. Crude kind of volatile on the back of the inventory build we saw yesterday. NatGas was up 3.87% and bonds gained as well. And the stock bond correlation continues to be somewhat positive. When stocks move up, bonds generally tend to move up. Now let's actually talk about the S&P 500, and there's not really much to say here, guys. Look, we're just consolidating the gains we saw from yesterday. We're in positive gamma. This is what we really needed. Now we did see a bit of selling from the highs here. We also did see quite a bit of buying at the lows right here. So tomorrow's trade is really going to be dependent on the housing data we get and what yields are going to do. A lot of the earnings and the economic data is behind us. So tomorrow is really going to depend on just like pure market momentum. So if we actually see yields continue to move lower, the dollar continue to move lower, S&P 500 should move up. If we get a little bit of a bounce in the mega cap names, we should see the S&P 500 bounce to the upside as well. In fact, the S&P 500 kind of flat when some of these larger cap names like the Nasdaq 100 down 0.29%. But we are in positive gamma for the S&P 500. Same with the Nasdaq 100, and we're doing exactly what I said we would do yesterday, and that's consolidating here, but we're staying above the positive gamma zone, and that's very, very positive because that means we probably do go higher unless we actually go ahead and break the gamma flip zone. But we wouldn't just need to break it, we would need to break, consolidate below, and then make a move lower, because we can actually go below. Like you see, we had a wick right here in today's trade, but we came back above into positive gamma. And that's very, very positive. You want to see a close below the positive gamma zone, then we can target the lower levels. But for right now, we have to trade the plan, and that's for the 21,700, or to be specific, 21,680. That is the level we're targeting in the Nasdaq 100. In the S&P 500, right now, we're just targeting the 6,000 level. I think we definitely will get there if we continue to consolidate above the gamma flip zone. The RTY, very, very solid momentum. We did actually see some positive momentum in the put support zone. The put support moved up ever so slightly. So too did the gamma flip ever so slightly. And we are actually holding on to the huge gains we saw here. And now we're still targeting the 2300 area in positive gamma for the RTY. And I mean, guys, the second we go ahead and actually break above this 2300 area, which is the high of this consolidation period, if we go ahead, do that, consolidate, Bob's your uncle, and then it's up and away, and then we can go target these 52-week highs, and in some cases, even all-time highs for the RTY. I'm bullish on small caps, mid caps. I think they're going to do very well this year, and we're starting to see that. Look at the RSP, look at the IWM, outperforming the broader large cap market. Do be aware, guys, that stocks as a whole are still about 15 minutes from the close, and the RSP probably looking the most constructive. It's actually retaking the high from this consolidation period. I said yesterday, as long as we're above this line, we should move onward and upward. And I think the RSP will probably continue to build from here. Next target is probably the 182 level. That's the next target. But the second we cross probably above this level, the 181 level, it's probably a moonshot, because this is like very low volume trade. I think once we break above this 181 level, we're going up and away in the RSP. That's a very, very solid looking candle. That's a bullish candle. You want to see that. That's like a breakout. That's a breakout and a breakout candle. You love to see that after a gap up and go. Breaking yesterday's open, breaking yesterday's wick high, and we are probably going to close at that level. Very solid price momentum in the RSP. The broader market looks really, really strong here. Large caps coming a bit under pressure. Nonetheless, I think equities look good, guys. And I think where you really want to look for opportunities is in the mid cap space. Something like Evolution, right? If you look at Evolution AB today, they were up in a very solid way, up 1.42%. Now there have been a little bit of a dumpster fire, but these are the type of names you want to be looking to add single stocks to your portfolio. They trade at very attractive valuation and are growing their top line and bottom line. And the catalyst for these names is going to be earnings in the next couple of weeks. Evolution reports earnings on the 30th, and I think we're going to see a very solid beat. Another mid-cap name that I like is Paycom Software. And I also do like PayPal. You guys know this. I almost say it incessantly. PayPal's had a very good run, and I think Evolution's next. And I still like all of these names. They're still trading at relatively absolutely attractive valuations. PayPal, even up here, trades at an 8% free cash flow yield, something like 6.9% when you adjust stock-based compensation. All in all, that's still well above the 10-year yield, which is at 4.6%, and you'd love to absolutely see that. But guys, you know where I stand right now. We are buying dips, selling rips. We're in positive gamma in the S&P 500, targeting the upper levels of 6,000 for the NASDAQ 100. That's the 21,680 level, and for the RTY, it's the 2310 level flat. From there onward and upward, and in the RSP, they're looking for the 182. But once we break that level, we probably go to the 190 and then target 200 and above. Equities looking very, very solid here today. A bit of consolidation. That's exactly what you want to see after a day like we had yesterday. For those of you that bought the dip, just hold. We probably will go higher into the inauguration, into earnings season. Earnings season set to be very, very good. I talk about earnings in the video, so go ahead, check out the earnings segment because earnings is beating in a very big way. Let's talk about sentiment, guys. This is the AAI sentiment survey. Just a question where active investors are asked where they feel the stock market will be in the next 6 months. And we saw somewhat of a capitulation, right? I mean, bullish sentiment has been ticking down ever so slightly. It's been a stair step down from about the 40% mark to where we are right now. And just in the last week, we saw a capitulation down to the 25% mark. This is definitely the signal to get long. This is a week to week sentiment indicator. It's not updated in real time. And so for all of the bearish sentiment we saw last week, with the tick down we saw here in bullish sentiment, probably goes to show that we are probably closer to a bottom, and we probably did put that bottom in middle to start of this week. We saw very much the same on the bearish side. We saw bearish sentiment tick up, sitting well above the historical averages in both instances. And guys, you want to buy into the fear. These indicators are contrarian indicators. When you see elevated bearish sentiment, that is the time to get long. When you see elevated bullish sentiment, that is the time to either hold, trim, and in some circumstances, maybe even short. Nonetheless, bullish sentiment very low. We also know with CNN's fear and greed index, we're still in that fear territory. So if history is anything to go by, buy the dip, don't trip. Now, regardless of what we see with sentiment, it's always good to go back to the fundamentals. And this is Q4 earnings season where we stand right now. Now, take all of these numbers with a grain of salt, guys, because only 28 companies in the S&P 500 have reported. And right now, we are seeing a slight beat in the S&P 500, although you kind of want to see more companies report. Earnings season really just started this week for Q4. But what we are seeing is very positive results skewed to the upside. 10.4% S&P 500 earnings growth. This is versing the consensus we actually got at the start of earnings season of 9.6%. We're beating ever so slightly on the revenue side as well, and margins are roughly staying the same. What's very important to note, however, guys, what's very important to note is that 81.2% of companies in the S&P 500 have reported above analyst expectations. The long-term average is 67%. So from what we're seeing right now, Q4 is shaping up to be a strong earnings season. However, there's definitely some risks. If we actually look at all of these sectors, right, there is 11 sectors here. Of those 11 sectors, 4 of them are actually reporting negative year-over-year growth. So all intents and purposes, financials, comm services, and tech, right, these big massive sectors that hold the magnificent 7 names, they're really holding up the market. However, we still see double-digit growth across the board except for utilities, which is at 9.9%. So the sectors that are growing at a very solid clip, while the rest of the S&P 500 sectors are actually seeing declines in earnings. So you could say there is somewhat of a bifurcated market. Nonetheless, we are expected to see earnings growth. And if you actually exclude the outlier here of the energy sector, you're actually looking at like mid to low teens growth for the S&P 500 and 5% revenue growth, right? Very, very interesting and very strong results regardless. So for those of you that are holding like the NASDAQ 100 or like a large cap quality ETF, you are seeing immense earnings growth this earnings season. And that is also further exacerbated by margins. Margins are set to grow. S&P 500 operating margins are forecast to expand in coming quarters. And we're looking at also posting some of the highest profit margins ever ever, except for what we saw here in 2021, 2022, and we are expected to exceed these highs in 2025 sometime into 2026. And guys, like I say on this channel almost every day, if earnings are growing and margins are expanding, stocks tend to do very well in that type of environment, and you want to buy and hold stocks. Now, a lot of this could already be priced in. We do know that equities, stocks, the US market is trading at 22 times earnings. And if we actually look at what we historically do in a bull market, generally speaking, the third year of a bull market, this is where we are right now. This is 2023. This is 2024. This is where we are in 2025. The third year of a bull market tends to be very flattish gains. It tends to be a little bit volatile. And here's the reasoning, right? In a bull market, the first 2 years tend to be very, very bullish. We price a lot of the growth and the margin story into the stocks via the multiple in these years. Then we take year 3 as a digestion. Generally speaking, though, earnings and margins tend to hold up in the third year. And after a solid year of digestion and sideways price momentum, the bull market continues into year 4, 5, and 6, all seeing mid to high teens capital appreciation. And this is in the S&P 500. However, if you want to generate alpha in the third year of a bull market, this is where I reckon you should be positioned. I still think you want to be overweight US equities. I think where you want to be positioned specifically is mid caps and small caps. I think these stocks are going to do very well this year, and maybe some like value stocks. I think defensives you should do well as well, but you want to remain not underweight, but neutral cyclicals and large caps, guys. You want to hold stuff like Meta, Google, Visa, Nvidia, Apple. I hold Visa in my portfolio. I hold Meta in my portfolio. I'm not selling those stocks. And for those of you that have a more strategic view and a market weight approach to your portfolio, I would really look at the small cap and mid cap segment. They're looking attractive based on valuations. There's favorable economic policy, deregulation, policy risk is not that high. We are technically in a cutting cycle with anywhere from 1 to 3 cuts set for 2024. And that's going to benefit mid caps. That's going to benefit small caps. Also, a stronger dollar does tend to benefit these stocks over large multinational corporations. So guys, look to small caps, look to mid caps, still hold large caps, but really you're gonna see outperformance in some of these other names, especially in the third year of a bull market. Nonetheless, you do want to hold equities broadly because the macro is very, very solid, guys. We're just going to take a big picture view of the overall macro environment. Atlanta Fed's GDP now Q4 tracking sitting at 2.8%. That's very solid and robust growth. A little bit off the highs we saw here at the start of the year. However, that is still very robust growth. You love to see that, and sitting at the top end of the blue chip consensus. The unemployment rate at 4.1%. We saw a downtick. This is very solid. This is probably telling us we are at full employment and the labor market is holding in there. Looking at the Redbook Index, a weekly gauge of retail sales, we saw 4% growth in the most recent week. That was this week. And we saw December and November, we saw very, very robust results. Look at this, above 6.4, 7.1%. 5% growth week over week in this holiday season. And you know that Q4 earnings is going to be good because the US consumer was spending, and also inflation. We continue to see disinflation take a part. If we actually just exclude the overall shelter component and look at every other aspect, we are at the Fed's target. We do know that shelter disinflation and or deflation is about to take hold. We saw that in yesterday's CPI report, and this is going to give the Fed the power to cut 2 more times, maybe even 3 more times in 2024. And so the macro environment looks very, very good today, guys. And guys, we are coming to the tail end of the first week of Q4 earnings season. We've had a blockbuster week. It's been absolutely crazy, from financials to some of these semiconductor names, TSMC, blockbuster earnings, some of these healthcare names, United Health. But it's been a fantastic week, but it's not over just yet. Yet we have SLB, Fastnell, Truist, and State Street all reporting tomorrow before the open. And then with data, we have building permits and housing starts. So we do get some housing data along with the financial data that we get. If we get good housing data coupled with lower than expected CPI and the retail sales numbers we got today, that's just a recipe for us to continue to move higher into the inauguration, into the end of January. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.